In today's video, we are going to have an overview of the Federal Reserve, also known as the Fed. So, to get started with some terminology and details and characteristics, we'll start with the general term, which is central bank. A central bank is what determines, implements, and controls monetary policy in the country in which they're in. So countries will have a central bank, and that's the general name for the institution that deals with monetary policy. Typically speaking, or the general two key things is supply of money and interest rates. There's a lot more to it, but those are the typical ones. That's different from fiscal policy, which typically deals with government spending and taxes. There's more to it, but that's just to at least start making some clarification or distinction between those two. So the Federal Reserve is the name that we give the central bank of the United States. The nickname is the Fed. So it was founded in 1913. Now, think about it. The country was born in the 1700s, late 1700s, and it was not until 1913 that we created uh, the Federal Reserve. So it's an independent central bank. By independent means that the executive branch, president, etc., the legislative branch, Congress, etc., and the judicial, that's the Supreme Court, cannot dictate what the central bank does. Now, can they influence? Sure. Do they try to work together? Yes. Especially when you have a situation in the economy where you need to apply fiscal policy and monetary policy. There's nothing wrong with them talking to make sure one doesn't counteract the other, or they do one thing in monetary policy, do something else in fiscal that creates actual problem in the economy. So can they work together? Yes, they consult each other, etc. Can they influence each other? Sure. How much of that influence happens is supposed to be independent. I'll let you take a political science class to decide how independent they may or may not be. And it's different from country to country. So it's always something to be aware of. Now, this is not a legal environment course that is important for international finance, but it's important to understand that central banks in different countries may or may not operate the same way in relation to the actual government in the country they're in. Duties incorporate four major functions: conducting monetary policy, as we mentioned, supervising and regulating depository institutions. Pretty much they supervise the banks. There's more to it, but to keep it simple, your commercial banks and your personal banking and all those. Maintaining the stability of the financial system through monetary policy. Providing payment and other financial services to the U.S. government, the public, financial institutions, and foreign official institutions. So money does go. There's a balance sheet, and the Fed has a balance sheet, and money does flow through them for many transactions. The structure of the Federal Reserve System. So they are 12 Federal Reserve banks in cities throughout the United States. Each acts as a depository institution for the banks in its district. So because it's only 12, but we have 50 states, a district can be several states. Operate under general supervision of the Board of Governors. Each has its own 9-member board of directors. So each of the 12 Federal Reserve banks has its own board of directors, but there's also an overseeing board of governors. Nationally chartered banks are required to become members of the FRS, the Federal Reserve System. 7-member board of governors in Washington, D.C. That's the board of governors that oversees everything. Each member appointed by the President of the United States and must be confirmed by the Senate. Members serve a non-renewable 14-year term. Primary responsibilities are the formulation and conduct of monetary policy and the supervision and regulation of banks. Some other, I guess, things related to the Fed is the Federal Open Market Committee, is the major monetary policy making body of the Federal Reserve System. They're required to meet at least 4 times each year in Washington, D.C., but typically meet more often. And especially if there's inflation, recession, there will be a lot more talks. Main responsibilities are to formulate policies to promote full employment, economic growth, price stability, and the sustainable pattern of international trade. So full employment. Now, full employment does not mean zero unemployment. That's for a different course, but there's a certain percentage of unemployment that is considered healthy in the economy, and they can call it full employment. Economic growth, self-explanatory. You want the economy to grow. Price stability. So you're not, mainly this refers to inflation. You don't want prices to spiral out of control, but also volatility of prices. Big shifts up and down in prices can be problematic as well. And international trade, you want a healthy international trade, and how that trade opens or gets constrained depends on how the economy of the country is going. It sets guidelines regarding open market operations, the purchase and sale of U.S. That's what open market operations are when we talk about the Fed, is the purchase and sale of U.S. government and federal agent securities as the main policy tool to achieve monetary targets. So when one general way to talk about that is when the Fed purchases securities, it's putting money in the economy. So they're buying stuff, and that means cash is going in the economy. When they sell them, they're taking money out of the economy. This has to do with the supply and demand of money, and you can moderate and regulate a healthy economic environment through these transactions. Beige Book summarizes information on current economic conditions by Federal Reserve District. Beige Book is a publication. Functions performed by the Federal Reserve banks: assistance in the conduct of monetary policy, set and change the discount rate. This is the interest rate. Every time you hear about in the news, oh, the Fed is going to increase or decrease interest rates, this is what they're talking about. Loans transacted through each FRB discount window. This is a relationship between the banks, the consumers, the Federal Reserve, and all that, but they do work on that to facilitate economic movement and growth. Supervision and regulation. Each FRB has supervisory and regulatory authority over the activities of state chartered member banks and bank holding companies located in their districts. As we mentioned before, they oversee the banks. Consumer protection and community affairs possess authority to implement federal laws intended to protect consumers and credit and other financial transactions. There's a lot more to it. They're just part of that game because Congress also is involved, consumer protection agencies, things like that. Government services serves as the commercial bank for the U.S. Treasury. So they do serve as a bank for the federal government, the same way a company would use any commercial bank out there. So, new currency issue, responsible for the collection and replacement of currency from circulation. So, while that bullet makes it sound that, okay, so you got dollars and actual paper money that is kind of ruined or whatever, already worn out, they collect it back and replace it with new bills, paper and coin. But at the same time, while it looks like collection and replacement of currency, If there's ever the need to literally print money, they'll be the ones to deal with it in conjunction with the mint. Check clearing operates a central check clearing system for U.S. banks, routing interbank checks to the DIs on which they are written and depository institutions, also what that means, DI, on which they are written and transferring the appropriate funds from one bank to another. So somebody writes a check, the check, and they deposit. Somebody with a checking account in Bank A writes a check, gives it to somebody that banks with a different bank, so that check goes over there. So then Bank B will process that check through the Fed to clear it through the other bank. So there's a multi-step process, a little more complex than you see. But now, as checks become less and less of a thing, there's less of a need for this service, but it's still out there. Wire transfer service, FRB, and member banks are linked electronically through Federal Reserve communication systems. So just like it sounds, wire transfers are electronic stuff, and so it goes through the Fed and the communication systems. Research services, each FRB uses professional economics to conduct research. So they do hire economists, people with economics degrees, and they conduct research because it's important to understand what's going on in the economy for them to make those decisions that influence the economy. As I mentioned before, there is a balance sheet in the Federal Reserve, which we'll typically see in the liabilities of the Fed. Major liabilities on the Fed balance sheet are currency and circulation and reserves. So that's uh, now, just like a bank, financial institutions, the assets and liabilities look a little different. For example, before I continue this, in a regular bank, a personal bank, people that have their money in that bank, that cash is a liability. Now, the bank itself has its own cash holdings as a business, and that's an asset. So there's a be a cash account and liabilities, but that's because it's a cash that belongs to the clients. So similar to that, they have currency and circulation and reserves that's in their liabilities. It's not theirs to spend. The sum of which is reserved as a Fed's monetary base or money base. Total reserves can be classified in two categories. Required reserves are those the Fed requires banks to hold by law. Excess reserves are additional over and above required reserves. Required reserves is very important when it comes to money supply. But just to define it here, if a bank has $10 million of deposits, people that have their bank accounts and they have $10 million, and there's a required reserve of 10%, let's say, then the bank always have to have $1 million in reserve. The other $9 million can be used for loans and other financial tools for the bank to do business. Excess reserve, just like it sounds, anything above that $1 million in this example will be an excess reserve. Assets. Major assets are treasury and government agency securities, treasury currency, and gold and foreign exchange. Interbank loans are a small portion of total assets, but they play an important role in implementing monetary policy. Banks borrow and lend between each other at different rates, and how much they can do that depends on their required reserve, excess reserves, etc. So, speaking of monetary policy, which tools do they have to implement monetary policy in the economy? The key ones, open market operations, those deal with supply of money. Those are the ones that we spoke about when they purchase or sell securities in the market, in the open market. Discount rate, this is when they increase or decrease the interest rates. Reserve requirements, it's what I spoke about earlier in the example of a bank having $10 million, and if they have a required reserve of 10%, then the bank has to hold $1 million at all times, and they can use other 9 million to as loans, for example. Now, if the if as a monetary policy tool, how does that work? They can increase the required reserve to, let's say, 20%. So now the bank has to hold $2 million and can only lend out 8 million. That's how they can go ahead and decrease the amount of money in the economy. If they want to increase the amount of money circulating in the economy, they'll lower the reserve requirements. Tools, depository institutions trade excess reserves held at their local Federal Reserve banks among themselves. So remember, they got a required reserve, but if they still have a little more, they can work with other banks to put that money to use, and they'll earn they'll get a benefit from doing that using their required excess return in some other fashion. It may not be as lucrative as dealing directly with a consumer in the economy in the markets, but if you have the money and it's not that you don't have opportunities to use it in loans and other stuff, then this is the other alternative. Talking some more about the discount rate, which is the interest rates you always hear in the news, whether it's going up or down. When there's inflation, one way to control inflation is by increasing interest rates, which means people will borrow less money, or and that would contract the economy and it'll start curbing inflation. So there's less money out there going around. If you're in a recession, then you lower interest rates, making money easier to access, cheaper to access, and then it starts getting more money. So, for example, you have a recession, you can lower interest rate and also lower the required reserve, and that makes more money available at a cheaper cost to access, therefore stimulating the economy and moving out of a recession. And while speaking about how the reserve requirement has an impact on the economy, it's not a one for one. It's what they call, it has what they call a multiplier effect. What you see on the screen right now, the formulas to understand or visualize how the multiplier effect works, there'll be practice exercises for that. But what you need to understand here is that as you lower the reserve requirement, the amount of money that immediately becomes available has a multiplier effect. So in the example that I was given about 10% required reserve means keep 1 million, you're able to put $9 million out there in the economy to lend out. Well, it actually the impact it has on the economy is going to be above $9 million. More on that when you see a practical exercises of how it starts trickling more and more money into the economy. So it's not just that $9 million. Here's a bit of history from the tools that the Fed has to influence the economy and the money supply in the economy to fight recession or inflation accordingly, or to stabilize the any situation or maintain the situation as it is. They decided that interest rates will be the number one tool. It's not that they don't do the required reserve, or they don't do use the open market operations. It's just the interest rates became the I guess the main tool. And that's why you hear more about interest rates than anything when it comes to the Fed and their actions in monetary policy. Now, international monetary policies and strategies. Central banks guide the monetary policy in virtually all countries. Now, it says virtually because there's a country or two where that may not happen. Independence of a central bank generally means that the bank is free from pressure from politicians who may attempt to enhance economic activity in the short term at the expense of long-term economic growth. If politicians had power over the Fed, then whenever elections are coming up, they'll have the Fed do things for the economy to do better and then use that in their campaigns. for re-election, for example. That's what they're talking about here. But those short-term gains can actually have massive negative impacts in the long run. And that's why it's important that they are independent and free from political pressure or the current government in place. Other independent central banks, like the Federal Reserve, out there in the international stage, is there's a European Central Bank, which is a central bank for the European Union. Then you got the Bank of England, is a central bank for the UK. Remember that the UK, when the UK was part of the European Union, then the central bank would apply to them. However, once they completely separate from the European Union, they went back to having their own central bank. Now, banks that may have a little less independence, People's Bank of China, Reserve Bank of India, Central Bank of Brazil. If this the China example is always interesting because China has had a lot of economic growth for the last several decades. So they're doing well in that sense. And part of that has to do with that less independence the central bank had. The government had a little more influence and control over the central bank. Now, was it a good thing, a bad thing? Is it fair or not? That's up to the economists to debate. However, what I'm trying to say is within the country, was independence a good thing or not? Well, it depends on how you see it. I'm using the China example because being such a large piece of the world economy, so is India and Brazil, but China is the one that had that super growth in the last several decades, partly thanks to that less independence of the central bank. So that's why it's a little, I find it a little more interesting of the independence and how that worked. That's it for this video. We'll see you on the next one.